You've never met the people who decide whether you can rent an apartment, get a car loan, or qualify for a mortgage. They don't know your name. They've never spoken to you. They have no idea if you're responsible, hardworking, or trustworthy in any meaningful human sense. But they have a number, 3 digits, somewhere between 300 and 850. And that number, which you didn't choose, don't fully control, and probably don't completely understand, quietly shapes some of the most important financial decisions of your adult life. It's called a credit score, and the system behind it is one of the most fascinating, slightly sinister, and completely legal rackets in modern finance. Here's the thing though, calling it a scam is too simple. Calling it totally fine is also wrong. The truth is more interesting than either. Let's get into it. Alex is 23, just moved to a new city for a job, trying to rent an apartment. The landlord runs a credit check. Alex's score comes back at 618. The landlord says they require a minimum of 650. Alex doesn't get the apartment. Alex has never missed a payment on anything, has no debt, has never declared bankruptcy, has never done anything financially irresponsible. Alex's score is low because Alex hasn't borrowed enough money yet. Read that again. The credit scoring system penalized Alex for not having enough debt history, not for being a bad financial risk, for being financially inexperienced in the specific way the system measures. That's where we start. That's the flavor of this whole thing. A credit score is a numerical summary of your credit history, specifically how you've managed borrowed money over time. The most widely used score is called a FICO score, developed by a company called Fair Isaac Corporation. There are other models, Vantage score being the second most common, but FICO is the one most lenders use, so that's the one we're focused on. The score runs from 300 to 850. Higher is better. Most lenders consider anything above 670 good, above 740 very good, and above 800 exceptional. Below 580 is generally considered poor, and it will make basic financial life noticeably harder and more expensive. But here's the thing, most people don't know. A credit score doesn't measure whether you're financially responsible. It measures whether you're a profitable borrowing customer. Those are related, but they're not the same thing. This matters. Context is everything. The modern credit scoring system wasn't created by the government. It wasn't created as a public service. It was created by private companies, specifically Fair Isaac Corporation, as a product sold to lenders. Lenders, banks, credit card companies, auto financiers, mortgage providers need a fast, standardized way to evaluate the risk of lending money to someone. Before credit scores, lending decisions were more manual, more subjective, and frankly more discriminatory. Race, gender, neighborhood, and personal relationships influenced who got credit. Standardized scoring removed some of that bias. That's genuinely a good thing. But it replaced subjective bias with a specific mathematical model, one that defines creditworthiness entirely in terms of how you interact with the debt system. If you interact with debt in the exact ways the model rewards, your score goes up. If you don't interact with debt at all, your score stays low, even if you're financially solid. The system wasn't built for your benefit, it was built for lenders' benefit. The fact that it can also benefit you when used correctly doesn't change who it was designed to serve. FICO scores are calculated from 5 factors. These are public. Here they are, with approximate weights. Payment history, roughly 35% of your score. Have you paid your bills on time? This is the biggest single factor. One missed payment, reported to the bureaus, can drop your score significantly. Consistent on-time payments build it steadily. Credit utilization, roughly 30%. This is the ratio of how much credit you're using versus how much you have available. If your credit card limit is $5,000 and your balance is $4,500, your utilization is 90%, which is terrible for your score. Under 30% is considered good. Under 10% is better. Length of credit history, roughly 15%. How long have your accounts been open? Older accounts help. This is partly why closing old credit cards can hurt your score. It can shorten your average account age. Credit mix, roughly 10%. Do you have different types of credit? Cards, installment loans, a mortgage? The model slightly rewards having variety. The logic, if you can manage multiple debt types, you're a more proven borrower. New credit, roughly 10%. How recently have you applied for new credit? Every hard inquiry, when a lender checks your credit for an application, can temporarily lower your score a few points. Multiple applications in a short window looks riskier to the model. Now here's what's not in there: your income, your savings, your assets, your job stability, your net worth. You could have $200,000 in a savings account and a mediocre credit score. You could be living paycheck to paycheck with an 800 score. The score doesn't know and doesn't care about your actual financial health. It only sees your debt behavior. Your credit score doesn't come from one place. It comes from three: Equifax, Experian, and TransUnion. The three major credit reporting bureaus each maintain their own file on you. Each file gets its own score. They're usually similar, but not always identical, because not every lender reports to all three. These are private companies. They are not government agencies. They exist to collect and sell your financial data to lenders. You are the product. And here's the part that should make you mildly annoyed. These companies hold enormous power over your financial life. They collect your data without your active consent, and when they make mistakes, which they do, you're the one responsible for finding and fixing them. The Federal Trade Commission has studied this. Research has found that a notable portion of consumers have errors on at least one of their credit reports. Errors that could be affecting their scores. Errors they didn't cause. You're entitled to a free credit report from each bureau once a year through annualcreditreport.com, the official government-mandated site, not the commercial sites with the jingles that try to upsell you monitoring subscriptions. Check your report, find errors, dispute them. This is one of the few areas where being proactive has a direct, measurable financial payoff. Speaking of which, you've seen the ads. Your bank offers you free credit monitoring. Credit Karma exists. Experian has an app. They all want to show you your score for free. Why? Because showing you your score for free is how they get you to pay for things that aren't free. The credit monitoring industry sells, at various price points, identity theft protection, score simulators, premium reports, and financial product recommendations. Those product recommendations, credit cards, personal loans, refinancing offers, generate referral revenue when you sign up. Your score is the hook. Your financial anxiety is the funnel. This doesn't mean these services are evil. Some of the free tiers are genuinely useful. Checking your score regularly is a good habit. But understand what's happening. The company isn't showing you your score out of generosity. They're showing it to you because your attention to your score is worth money to them. The score itself isn't the product. You are, again. Here's where the real stakes are. Your credit score doesn't just determine whether you get approved for things. It determines how much you pay for things. Lenders use your score to set your interest rate. Higher score, lower rate. Lower score, higher rate, or outright rejection. The difference in interest rates between a good and a mediocre credit score, applied to a mortgage, can cost tens of thousands of dollars over the life of the loan. On a car loan, it can be thousands more. On a credit card, it's often the difference between a manageable APR and a brutal one. Some employers check credit scores as part of hiring, particularly for financial roles. Some landlords require minimum scores. Some insurance companies use credit-based scores to set premiums in states where it's legal. A low credit score makes basic financial life more expensive, which makes it harder to improve your finances, which makes it harder to improve your score. It's a cycle. And it disproportionately affects people who started with less, people with less credit history, fewer financial buffers, and less access to the products that build score in the first place. That's not an accident of the system. That's how the system functions. Back to Alex, who couldn't rent the apartment. Alex's problem was a thin credit file, not enough history for the model to generate a confident score. Here's what actually builds credit when you're starting from nothing. Secured credit card. You deposit money as collateral, say $300, and get a card with a $300 limit. Use it for small purchases. Pay it in full every month. The payment history builds your score. After several months to a year of responsible use, many issuers upgrade you to a regular unsecured card and return your deposit. Becoming an authorized user. If someone you trust, a parent, a sibling, adds you to their existing credit card account as an authorized user, their payment history on that card can appear on your report. You don't even need to use the card. Their established history helps build yours. Credit Builder Loan. Some banks and credit unions offer small loans specifically designed to build credit. You make payments on the loan. Payments are reported to the bureaus. Score improves. Some versions hold the funds until you've paid in full, so it's more like a forced savings account than a traditional loan. Student credit card. Designed for people with limited history. Lower limits, often higher rates, but they report to the bureaus and build history. The common thread: you need accounts that report activity to the bureaus, managed responsibly over time. There is no shortcut that actually works. Any service promising to dramatically improve your score fast for a fee is almost certainly either ineffective or outright fraudulent. This is the most actionable part of the video. Pay attention. Credit utilization, that 30% chunk of your score, is the factor you can move fastest. If you have a credit card with a $3,000 limit and you're carrying a $2,000 balance, your utilization is 67%. That's hurting your score significantly. Pay that balance down to $300, utilization drops to 10%. Score goes up, sometimes by a meaningful amount and relatively quickly. Here's the counterintuitive part. Requesting a credit limit increase on existing cards can also improve your utilization ratio without you spending a single extra dollar. If your limit goes from $3,000 to $6,000 and your balance stays at $2,000, your utilization just dropped from 67% to 33%. Better score, same behavior. Important caveat: don't request a limit increase if you're going to use the extra capacity to spend more. This only works as a score strategy if the balance stays the same or decreases. And don't close old cards you're not using. Removing that credit limit raises your overall utilization and potentially shortens your credit history. Both hurt your score. Leave old cards open. Put a small recurring charge on them if needed to keep them active. Pay it off monthly. Let the history age. People get paranoid about this. Let's clear it up. There are two types of credit checks. Hard inquiry: when a lender checks your credit as part of a formal application. Credit card, loan, apartment, sometimes a phone plan. This goes on your report and can temporarily lower your score by a few points. Soft inquiry: when you check your own score, or when companies do background checks, pre-qualification checks, or employment checks. These don't affect your score at all. Checking your own score does not hurt it. Check it as often as you want. Multiple hard inquiries for the same type of loan, say shopping for the best mortgage rate across several lenders, are usually treated as a single inquiry if they happen within a short window, typically 14 to 45 days depending on the scoring model. The bureaus recognize that rate shopping is smart behavior, not desperate borrowing. 1 or 2 hard inquiries per year is normal, not worth worrying about. The score impact of a single hard inquiry is usually small and temporary. Don't avoid applying for something useful just to protect your score from a minor, short-lived dip. Here's the honest summary. The credit score system is not a scam in the sense of being illegal or entirely fraudulent. But it is a privately created system that measures a specific kind of financial behavior, assigns enormous real-world consequences to that measurement, profits the companies that built and operate it, occasionally contains errors that you're responsible for fixing, and disadvantages people who simply haven't participated in the debt system, regardless of their actual financial health. It rewards you for being a reliable borrowing customer. If you are one, it opens doors and saves you money. If you're not, or if you haven't been yet, it closes doors and costs you more for the same products. Understanding this doesn't mean you should be angry at the system and refuse to play. The consequences of a low score are real enough that refusing to engage is just hurting yourself. It means learn the rules, play the game deliberately, and don't confuse a high score with actual financial health. You can have an 800 score and no savings. You can have a 650 score and a growing investment account. The score is a tool that lenders use. It can also be a tool you use. Just know what it's measuring and what it isn't. Here's everything. A credit score is a private company's model for measuring how reliably you borrow and repay money. FICO is the most widely used. It runs from 300 to 850. It measures payment history, utilization, account age, credit mix, and recent applications. It does not measure income, savings, assets, or actual financial health. 3 private bureaus, Equifax, Experian, TransUnion, each maintain separate files and generate separate scores. Errors on credit reports are common. You are responsible for finding and disputing them. Free credit monitoring tools are hooks for financial product upselling. Useful, but not altruistic. A low score makes loans, apartments, insurance, and sometimes jobs more expensive or inaccessible. Building credit from scratch, secured card, authorized user status, credit builder loan. Fastest score improvement. Pay down balances to lower utilization. Request limit increases. Don't close old cards. Hard inquiries temporarily lower your score slightly. Soft inquiries don't affect it at all. Shopping multiple lenders for the same loan type within a short window counts as one inquiry. A high credit score means you're good at borrowing. It doesn't mean you're good at money. Play the game deliberately. Just don't confuse the game for the goal. Alex eventually got an apartment. Took 8 months of using a secured card, paying it off monthly, and letting the history accumulate. Score went from 618 to 687. Landlord approved. 8 months, 1 card, 0 debt carried. Score went up enough to change the outcome. The system is gameable. Not because there's a trick, because you now understand what it's actually measuring and can give it exactly what it's looking for. That's not gaming a scam. That's understanding how the rules work and using them in your favor, which is, honestly, what you should be doing with every financial system you're forced to participate in. If this video made you want to actually pull your credit report and check it, do it tonight. Annualcreditreport.com. Free. Official. No jingle. Hit subscribe because next video we're going into how banks actually make money off your account and why the phrase, "your bank is your friend," is the funniest thing in finance. Drop a comment with your current score range, not the exact number, just the bracket. Curious where people actually are versus where they think they should be. See you there.